multiple timeframes, gold futures study, contract GC. Now, we are going to pick things up here, and we're using 4 timeframes, and we're going to trade them. So let's begin. Firstly, we have the daily time frame. This is our highest time frame. Via the daily, we have a trading range. Not that apparent until price unfolds, yet we're unable to make upside progress here at 1. We come down, we test this area, so this would be our lower boundary, and this resistance would be our upper boundary. A couple of months pass, and we come up, and what happens? We are unable to test the upper boundary. Consequently, we put in a new high at 2 as we react down, and this is a lower high. We'll note that. And by using our comparative analysis here, what can we see? Well, compare this bout of buying to this bout of buying. Buying between 1 and 2. At 2, we can say that the price action is very choppy. This is just slop. We can almost put a line through every single bar of this couple of months worth of trading. Whereas here we're driving up with some decent price action, as we can see here, closing firm. Where's the buying we see here? And what happens? We make a lower high. From the lower high, we see this bar here, negativity, as we can't break this area of resistance, and it closes under 1, 2, 3, 4, 5. It closes under a week's worth of trading. Now this action propels the market down. As we react from this bar, what would we expect? A test of support, as it's held here and more or less here, and we can see there's good selling. So we do come down, break support at 3, not the highest volume, as we can see. However, we would still expect some follow through, some downside progress, but this does not occur. We have shortening of the thrust here. We can't drive lower. Let's look into these bars, or let's analyze these bars around the shortening of the thrust in more detail. So first of all, let's look at break 3. It's not the most convincing break. Yes, over 50% of our spread closes under our area of support, our area of structure. However, volume does not increase, and we do close off the lows, which is respecting the demand line. So demand is coming in where it should, and so there is active buying in this bar. Then the following bar here. What can we note about this bar? Well, this is the volume here, and this is the volume for bar 3. We have effort versus result. This bar is a bullish case of effort versus result. The spread is less than half of bar 3, yet the volume is only a fraction smaller. Ergo, a bullish case of effort versus result. Then we have this bar here, one with this volume. What can we note about this action? Well, it's no supply. It's actually the lowest volume down bar or of any bar on the chart. All this action here equates to no supply after effort versus result. And this is quite a strong signal. When you get effort versus result preceded by a no supply bar, think about this logically, this action confirms the bullish effort versus result. We come down here, buying off the lows, volume isn't that great. Then we have a very good case of bullish effort versus result. Then we print the lowest volume down bar anywhere on the chart, which doesn't make any real downside progress. And what are we doing down here? We're holding the demand line. So selling is not having an effect. And bear in mind, no supply means no supply. So we're disconfirming supply. Therefore, we get the confirmation of demand. This is hinting towards a rally of sorts. Ergo, this action here, this shortening of the thrust and the individual bar analysis, we can say is some form of reversal play. Very interesting behaviour. Hinting, this price action here, that we're coming back to at least test here. And in an ideal world, we would be looking for, yes, a rally to ICE setup. However, price does head north, as we can see, and we break the supply line quite comfortably, and we close back above support on these two bars at A. And these two bars hold support. We don't need volume. We can see from the price action alone. We dip down on this bar under to reverse and close firm. Then we dip under again, reverse to close firm. And on the second bar here at A, we make a higher high, a higher close, and a higher low. So this action is bullish. Don't forget, we saw strong buying, then weak buying. We come down. We see shortening of the thrust, effort versus result, no supply. So we're looking for a weak rally back to here, if we're down here. And we'd want to apply a short play. Yet, we drive up, and we've got sustained volume here. So it's not this is not no demand. This is sustained volume. For no demand here, we'd want to see very low volume and a very narrow bar. Here, we're breaking resistance and holding newly formed support with fairly good volume, making a higher high, higher close, and higher low. This is bullish behavior. Okay, so we're at support and buying is emerging, or is at least refusing lower prices. And don't forget our background conditions here of strength of our little reversal play, our turning point. So when the market holds these two bars at support, we're in a bullish scenario. Naturally, what would be our target? Well, our first target from here, if we think the market is bullish, is here. Then 1. This is natural. So our first target to test is 2, and then 1 being our main obstacle. From these two bars holding support, we drive up. And what can we notice about this drive up? Well, this is very good buying. This is the best buying on the charts. Yes, we have this good buying over here, but look at the wave. Look how we're driving up, breaking supply lines, breaking resistance. This is different. Yes, this has wide spreads, closing firm, but this is a strong drive up. This is a daily time frame. So we've been pushing up for 3 weeks here. We've been driving higher. And we are always closing firm from here. Close firm, close firm, close firm, close firm, regardless of the volume. So in the beginning, the volume is sustained. Then we have low volume at C and increasing volume towards the end. What does this mean? We need to think deep about bar C. It's fairly complex. So bar C, although has low volume, what exactly does this mean? What does it suggest? Well, this indicates a lack of supply rather than weak buying. Why? Well, because all the sellers would have been wrong-footed down here. The break to 3. The sellers have been spooked out of the market. And we will see this time and time again. You may even see wider spreads with lower volume than C. One may argue that this is no demand at C. Well, no, not really, because we'd want to see a narrow spread like this, or even narrower like this, and the volume. But here we get a fairly wide spread. We'd say slightly over average over these spreads. What do we interpret this as? Ease of movement. Therefore, this is not no demand. This action here shows ease of movement, a lack of selling friction. So we need to take note of this behavior bar C. After, let's just call this a fake break. This breakout here traps traders. They're in position. And then perhaps as we hold here at A, with narrow spreads, and we're not breaking an area structure with a good wide spread up bar, like we know that how structures should break. After all, this is resistance. Then bar B, what happens? We break bar B with conviction. We break the highs of A with conviction and a pop in volume. Then this bar at C, this low volume, reflects a lack of selling participants. They don't understand. They can't read this turn. It's important to understand this behavior. For if we're in position, we don't get spooked out by thinking that bar C is no demand. We need to use context. And context here is of strength. We're refusing to go down. And look how we're driving up into new highs. Or we're driving up with the largest up wave at this point. So sellers are scared from B. This should not have happened. We shouldn't have broken these bars, and we do, in good fashion. Think like a seller here. Bar B breaks the highs, which was a surprise. So where's the next logical place to sell? It would be up here at resistance. You wouldn't want to sell in the middle of a trading range. That action doesn't make sense. Okay? We need to briefly talk about, or go into some depth about what's occurring in this buying within the white space of this trading range here. Well, we dip down, reverse to close firm. So we dip down, find no supply, reverse to close firm. We dip down, reverse to close firm. We dip down, find no supply, reverse to close very firm. So every dip down, we are disconfirming supply. There are no real deep retracements. Ergo, there is no selling pressure. So logically for tomorrow, from E, from our daily chart here, from E, what would we expect? Well, a dip down and reverse to close firm. Now, this is what's important. If we're going to break an area of structure, we would expect a wide spread, because that is how markets break areas of support and resistance. That we would expect high prices because of the way we move up, and we see no selling pressure in, or so should I say, from B to E after this context from the shortening of the thrust, the effort versus result, no supply. Then we push up. We don't react. This is a rally to I setup, and we don't react. In fact, we hold with two strong bars, refusing to go lower. And then we confirm no supply in the market via C. I see no negativity. No negativity from here. And this is a strong wave up, a strong solid 3 weeks of buying. And we are gaining momentum. What do you mean? Well, bars D and E, we are increasing in volume. So we would expect a break for tomorrow. I mean, one could make an argument that bar E is effort versus result over the previous two bars. But considering the context, the conditions via the background, we could say that demand here is overcoming supply, as in it's absorbing the supply. Why? Well, what would a weak bar here look like? Well, we know what a weak bar is a no demand bar. We would want to see a narrow bar with low volume, like this. Here we get the opposite. We have increasing volume, closing very firm. There is, obviously, don't get me wrong, there is selling in this bar. We know that due to the volume, higher than the previous bar and this bar, and the spread is smaller. However, due to the close and the nature of our drive up, and obviously the background conditions and context, we would have to go with the flow of the market, and that is of strength. Okay, This is how we need to think. We slowly need to piece this together. And the story is of strength. Just to reiterate this point of bar A being bullish effort versus result, as in absorbing supply, is because of the context and our background. And weakness here would be a narrow spread up bar with very low volume. Here, at bar E, buyers overcome any selling. That's a big difference. But I hope you can see this, what I'm trying to convey. Okay? So in our mind's eye, coming in for tomorrow, and we think higher prices are on the cards, our first obstacle to overcome obviously is this resistance, then this resistance here at 1. Now, due to the average true range of the bars, it's highly unlikely we will test resistance 1 through 1 day's worth of trading. Now, our average true range is the average spread of the, say the last 4 or 5 bars. And the way that price is unfolding, where we dip down and reverse to close firm, and to close like this, is it's a very large spread, and we have to absorb any selling pressure here and any selling pressure here. This is extremely unlikely, but of course possible. I think I have briefly covered this, but how would we expect price to unfold for tomorrow? Considering the drive up from B, we would have to go with the flow. We would expect lows to be made first, so we dip under, then we reverse to close firm with a fairly wide spread. As we are at resistance, if we do break, we would expect a wide spread and a pickup in volume. Now, can you understand the importance of what we're doing here? We're making a game plan. We're trying to predict what will happen for tomorrow's trading. Now, this analysis we do pre-market, then come into the trading armed with a game plan. If it conforms, excellent. If it doesn't, that's good too. Why? Well, because we can adjust quicker through disconfirming our game plan. We're not caught off guard in a live environment. We can adjust in the moment. Okay. Apologies for the rant. Let's move on and go on to the 60-minute time frame. Here we have the 60-minute chart. And for context purposes, this was yesterday's close. Okay, so bear with me. So the close here is the close here. So this action here is pre-market. This is part of the Asian session and part of the European session before we come into the main, the volatility where the volume picks up, which of course is the US session. I say that again, this area is the close, and now this is a brand new day, the Asian session and the European session. We have to make sure we're on the same page and we understand the context of where we are. So what do we notice? Well, we can say that during the early Asian session, we bounced our head against resistance. And then we grind through. There's no good buying quality here. There's no wide spreads or anything. Yet, as we do break higher or grind higher, we make a higher high ever so slightly. And then resistance, where we can see all along here, returns into support. Then we get a little bit of volume here, a little pick up that breaks all this local action here. We form a trading range, and then we get good buying via B. We break out of the trading range with a good wide spread and firm close. From B, we would expect higher prices. We would expect continuation to the upside. We bump ahead against resistance. We grind through. We come back to react. We can't. Resistance turns into support. We break higher on a little pop in volume. We hold a mini trading range, and then we break out with excellent buying. Good wide spread up bar closing firm. And if we look within the channel, we can see good buying everywhere. It's dominant. And of course, we have the uptrend channel itself, which has lasted 1, 2, 3, 4, 5 days here. And if we do expect upside continuation, for this time frame, we would expect supply around here, because this is the supply line. We'd be overbought in this area, so that would be an area of interest. Okay, so there's nothing to do here. This is just before the US Open, maybe an hour before, but we would still need to do our analysis. We'd do our pre-market analysis of our daily. Then we come in an hour before the market opens, we recognize this overnight action, and we take this into consideration. And this behavior, this price unfolding, conforms to our pre-market analysis of higher prices. We've already broken through resistance, being yesterday's high. Okay, let's drill down to the 15-minute chart to see if we can gain any further additional data. Yes, it does, and we can. The 15-minute chart becomes a lot clearer. We gain incredible insights. This is where multiple time frames come into a world of their own. They help immensely. Let's orientate ourselves and give context so we know where we are. So this is the 15-minute time frame. As we can see here, the 9 o'clock is the close. So this was yesterday's close. And all this action here is the pre-session, which we've just analysed on the 60-minute. So the Asian and the European. This close here, B, is the close of B here. And this is the close of the previous day on the 60-minute. Good. Now let's dissect this chart. What can we see? Well, when we come in to yesterday's high on this time frame, we can see that resistance was holding. It was fairly strong. We hold, resistance. Yet look, the lows were rising. They're continually rising, bumping our head up against our resistance. Then boom, what's this bar here? It's a shakeout. It closes under all of this. What, this is a 15-minute, closes under multiple hours worth of trading. Then we get no downside follow through. If this is genuine weakness, and that is an upthrust bar or hidden upthrust, we would expect downside continuation. Yet there's zero, nothing. We hold, and then we grind up and we push through resistance to make a higher high. And this grinding makes sense. Previously spoken about shakeouts and how price can appear to levitate up. And why is that? Well, it scares the sellers. It's exactly the same psychological impact as the fake break we've just analysed via the daily. It spooks the sellers. So price can appear to levitate. So this is a market phenomenon, or a characteristic of market behaviour you must become familiar with, because it happens, especially if you want to trade oil. Oil loves a shakeout. Again, it does depend on the personality of the instrument or asset class you wish to trade. Okay, so we had fairly strong resistance, and that once broken, what happens? We come back and it's now support. It turns to support. And what is S1? Well, S1 is spring in action, which is bullish. And what can we note about the two bars after the spring? This bar and this bar with this volume. A small narrow spread down bar with low volume. These bars are no supply bars. We could buy, if we're in front of our screens at this time, any of those bars. And what should we expect after these two no supply test bars? Well, we would expect instant gratification, a good response, and we do. Don't forget, these two no supply bars disconfirm the presence of supply. And where are we? We're at support after some spring in action, where we had decent resistance, so should now be decent support. and we are getting a story of strength here. Think about this action. We spring, no supply, instant resolution. We break resistance and we push up higher. We make another higher high. All this is very bullish behavior. This response after the no supply bars is what we expect. We should know this from our previous sessions. As we drive up to make a higher high, we come back down to here and we hold another higher level of support. What was once resistance here and here has now turned into support here, here and here. And what can we notice about this price action? We'll look at S2. Interesting. We have a big, large pop in volume that closes mid-bar, indicating buy-in. And there is no downside follow-through from S2. It doesn't even touch this support level. Okay, this is very blatant buying to the trained eye. So from S2, we push up and we come back and revisit via S3. Now this is a small, narrow bar closing off the lows at support with much lower volume than the original touch here, or try to touch via S2. So what is this action doing here? Well, this is hinting at no supply. There is not enough selling force to break. And we can also see a cluster here. You know, price is just refusing to go down. And again, S3 is hinting at no supply because we're trying to break on much lower volume. Agreed? Then what happens? Boom. Instant gratification once again. Breaking through resistance. Isn't this action amazing? Oh, before we move on, what is this area here? This is the trading range here on the 60-minute chart. Now, via the 60-minute chart, this trading range doesn't look particularly useful. Yet when we zoom in to the 15-minute chart here, we can see we have effort versus result. We have some buying. We're holding decent support here. Then we get no supply, and now we're driving up into brand new highs. And look how we break. Widespread, good volume, closing firm. We have a little shortening of the thrust on the next bar with slightly lower volume. And then we come to bar B. Now bar B, volume declines, closes off the lows after the highs have been rejected. So this bar here is testing action. Okay, think about this. If bar B was indeed weak and loaded with supply, selling, we would have higher volume and a weak close. We would print like this. We could come up and then we'd come down. See, that is negative behavior. Here we come up, okay, bit of selling, but we come down. Find no further selling. Buyers come in to step it above this close and above the high of B. Bar B achieves something. It's testing action. Okay, so here we get the opposite of weakness. We don't get a down bar like this. Let's do a brief recap. Bump ahead here on the 60-minute, we hold at support. We push up, we hold a mini training range, and then we get uber strength from B. Very good strong price actually, telling us that higher prices are on the cards. Hinting at higher prices. Yet when we drill down to the 15-minute, wow. Resistance, resistance, resistance strong. We get a shakeout that propel and then we levitate through, grinding through. This resistance level now turns into strong support, which we spring. We have no supply test bars. Instant gratification. We drive up to make higher highs. Effort versus result. Another no supply bar. Then we get excellent price action. Then we get some testing action at B. This is all bullish behavior. Both time frames have a story of strength. So we want to be buyers. Now this is when we go down to our lowest time frame, being the 5-minute chart, And this would be our entry trigger bar time frame. Here we have the 5-minute chart, and for context again, G here is the close of B on the 15-minute here, and of course the close of B on the 60-minute. So we're using multiple time frames. We're using the 60-minute, the 15-minute, and the 5-minute. Now, what can we see? Well, we hold yesterday's high for an extended period of time. As we can see, we hold it for many hours. We spring via A with some decent volume. We come back and we test very narrow bars, very low volume. Straight after the test, we rally and break into new highs. Volume increases, we get some decent spreads. As we do drive in to make a higher high, resistance here, resistance now turns into support, support, support. Then C prints, bang. Now what is that bar? Huge surge in volume. Spread increases, looks very negative. Boom, yes, bar C is a shakeout, and look at the volume, huge. And this action, this shakeout bar, slams straight into support. This happens so frequently. I have mentioned this many times during our sessions. Now, I wouldn't say that this is bullish behavior, because we don't know it's a shakeout via the close of bar C. We don't have any of this data. So we are still thinking lower prices are on the cards. But logically, think about this logically, with all of this volume, we're talking 6 times, 5, 6, 7 times more than the previous bars. We'd expect a spread to be 5, 6, 7 times in long, which would give us a spread like this. So if all this was supply related, as we are coming down, we should have a bar like this. So by using logic and our deduction of the spread bar volume relationship, we know that something is suspect by C. However, price action rules from here, although suspicious, we'd still expect some kind of downside follow through. Yet look at this, 0. In fact, we come up, test the highs, and we bounce around again within this trading range. Then we revisit this shakeout area down here on much lower volume via D. For 2.5 hours, we have no follow through from C. Then we come back, we revisit on lower volume. So there is no downside follow through. At this point here, we know for sure that C is a shakeout. And now we know that a shakeout is actually very bullish behavior. Can you see how we piece this together now? From D, the market gets going and we drive higher to E with increasing spreads and good volume. If anything, a little high volume. Slightly climactic, which is probably why we get this pullback. And on this pullback, what do we note? Bar F. Bar F is the lowest volume down bar we can see since the volume has picked up from this new wave higher. We can interpret F as no supply. It's indicating no supply. Then G, look at G. G is strength. We come down, find no further supply to reverse and close above bar F with a surge in volume, and then we hold this local level of support. Think about this bar. This bar is the close on the 15-minute time frame here and the 60-minute time frame. So by using context from the other time frames, we can buy this bar confidently. Try to think logically about the behavior of bar B via the 60-minute time frame. If we look at bar B, we push up and we come down and we close like this. So we have a mini retracement. We just close off the highs. We dig down to the 15-minute time frame here, and it's clear that we come from strength. Resistance, resistance, we hold support. We have evidence of some kind of shakeout, effort versus result. There's buying. Then we test. Then we drive up. So there's strength. Then via the 5-minute chart, we have a change of behavior wave, telling us that demand is in the market. Then from E, which is the high of the 60-minute bar here, we retrace. And the retracement is very weak. We've said there's no supply in bar F with evidence of buying at G. So our retracement on the 60-minute bar is actually bullish. Why? Because this indicates there is no supply. The stage is set for higher prices. Hence, we can buy this bar with confidence. Can you see how powerful that multiple time frames can give us, can aid us? Let me say this once more. This is our 60-minute bar with the retracement to the close. From the 15-minute time frame, we know that we come from strength. And this retracement, so this bar E here is the high of this 60-minute bar. And this is the close, which is bar G here. So this retracement is here, which is telling us there's no supply via F, followed by good buying after this change of behavior. We have a shakeout, huge shakeout in the background, which we test, which gives us this instant resolution of a change of behavior wave up. The stage is set for higher prices. Okay, it may appear aggressive buying, but it isn't, because the 5-minute chart here is disconfirming supply. And if we go to the 60-minute chart here, we can see this is strength with good buying, and we have all this open white space. There's no trading to the left of us because we're in a huge uptrend. Odds favour that we should drive up, hopefully test somewhere in this area. Okay? Isn't this fascinating how we can use all these time frames to help us gauge a picture of strength where we can buy this bar G extremely comfortably? There is something else that we can add that may aid to making a sound decision. We have resistance via our daily trading range. So this is 2 resistance, and look where we are. For context, let me go back just to remind you. So we are here on the 5-minute chart. This is our 2 resistance. It's of no surprise now that we react from E, that we had a pullback. However, it's minimal via the 5-minute chart. G holds this level. We dip under F to reverse and close firm back above low of F and at resistance. You know, we have a close firm after bar F, which is no supply. Think logically about this. We would expect selling at this resistance level. Why? Because this is a daily structural area where we have held previously. And ask yourself now, is there any selling pressure here? No, of course not. We get the opposite. Bar F is no supply at resistance after a strong move. So we can buy G here right at the danger point. We just put a stop here. And if we're wrong, we are wrong. Hopefully you are all beginning to see the power and the use of multiple time frames and how it helps to connect all the pieces of the puzzle, how they all come together. It truly is a wonderful tool or skill to have. Now, I'm under no illusion. Multiple time frame analysis is complex and very advanced. Many professionals do not know how to use this type of analysis correctly. It will take time and practice to master this art. And a good starting point, which worked for myself, is to try and think in multiple time frames at all times. Saying that, multiple time frames is not needed to be successful or to trade our methodology. It's discretionary after all. However, I would urge you to take the time to learn this process, as you will have a very, very powerful tool in your trading box. On this study here, without the aid of multiple time frames, could you buy this bar? If we were just using the 60-minute chart, I couldn't buy that because we're in the middle of a trading range. Yet, when we go to the 5-minute chart, with no other time frames, quite an aggressive buy. However, with the guidance from the 60-minute and context from the 15-minute of that being strength, this now becomes a high odds play. This suggests that we're going higher, which of course is in sync with our 60-minute bar here. And our target would be here, our supply line from our channel that has held for over 5 days. Just to finish this study off, this is the preceding day. So we were here and we continue to rally. Bang, right at resistance. This is what we would expect. There is a question here. Do all time frames have to be in alignment? Yes and no. Again, paradoxical within trading. Who would have thought? You want, yes, in an ideal world, the higher time frames pull the lower time frames. But as I have previously said, the market turns will obviously appear on a lower time frame first. So there goes the paradoxical environment. If, for example, if we're coming down like this, we have good selling, and then we have shortening of a thrust. This is still a down bar. Say we close here. This is still a down bar and we're coming down. But if we analyze this bar here, let me draw this clearly like this, into 5-minute bars, so that's 12 bars. Come down like this. And then we bob down, we hop up, bob down, we have a little bar, we come down, 2 no supplies, then we come up, we come up, we come up, and we can see that we have a clear buying zone. We would say that this bar, we can see strength here on the 5-minute. We have a clear buying zone. There's no volume in these down bars here, with good excessive increasing volume here as we're trying to hold. Even though the 60-minute time frame is down and we're trending down, and we may notice shortening of the thrust, via the 5-minute time frame, this is our turning point, and we want to be buyers, so it's not conducive, or it's not as apparent using the higher time frame. I see no further questions. On to the next study.